Every sponsor writes an exit thesis at acquisition. It describes who the buyer is, what they will pay, why they will want this asset at the end of the hold period. Most sponsors never formally update it. By year 4, the buyer universe has shifted, the market is repriced, the management team is optimizing for metrics the eventual buyer may not weigh. The board is governing a company toward an exit that was designed for a market that no longer exists. That is not a process failure, it's a governance gap. And the cost of that gap does not arrive until the exit process begins, at which point the options for correcting it have narrowed significantly. The assumption embedded in most PE hold periods is this: the exit thesis written at acquisition remains the correct one. The buyer identified in the IC memo is still the likely buyer. The strategic rationale that made this asset attractive at entry will still make it attractive at exit. This assumption is rarely stated explicitly. It's embedded in the governance architecture of the hold period itself. The operating plan optimizes for the metrics the original buyer would value. The board reviews performance against the value creation plan, not whether the exit that plan was designed to enable is still the right one. The exit thesis governs everything downstream of it: the operating plan, the EBITDA targets, the management incentives, the hold period decision. When it decays without a formal re-examination, every downstream decision compounds the error. In an environment of 3 to 4 year holds and stable buyer markets, the exit thesis written at acquisition was a reasonable governing document. The buyer universe did not change dramatically over 3 years. The thesis did not need to be a living document because the environment did not change fast enough to demand re-examination. Two things changed that. The first is the hold period extension. When the average hold extends beyond 6 years, the buyer universe at year 6 is materially different from the one at year 1. New categories of buyers have entered the market where they had no presence at acquisition. The buyer the IC memo described may no longer be the highest bidder or a bidder at all. The second, a market is repricing. The valuation framework that produced the entry multiple was written for a specific rate environment and a specific risk appetite. Those inputs have moved, and in some cases dramatically, since the deal closed. A thesis written for a 3-year hold in a sustainable market is not the right governing document for a 6-year hold in a market that is repriced twice. The exit thesis decays in 3 directions simultaneously. The first is the buyer universe. Sectors consolidate. Platforms that were potential acquirers at acquisition have since been acquired themselves. Some buyers in the original IC memo have changed strategic priorities enough that this asset no longer fits the thesis they would bring to a process today. The second is a valuation framework. The multiple the thesis assumed was calibrated against comparable transactions at acquisition. Those comps have aged. The multiple that seemed conservative at entry may be optimistic at exit, not because the business underperformed, but because the market assigning that multiple is a different market. The third is the management optimization problem. Management teams optimize for what they are measured against. If the incentive structure was built around the original buyer metrics, and that buyer is no longer the likely acquirer, management may be investing energy in improvements the actual buyer will not underwrite. Management is doing exactly what they were asked to do. The question is whether what they were asked to do still points toward the right exit. That's not a management failure, that's a governance failure. The exit process begins, the sponsor launches based on the thesis written at acquisition. The buyer universe contacted reflects that original thesis. The buyers who show up are not the buyers the thesis assumed. New buyers enter who value the asset differently than the original thesis modeled. The management presentation is built around the narrative the original buyer would have valued. For the buyers actually in the room, parts of that narrative land, parts don't. The bid-ask spread is an exit process that's not always